You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host as always. Welcome to episode 299. I wonder what episode 300 will be. But before we have that big milestone mark, I couldn't not have a chat with my favourite mortgage broker in Western Australia, the number one mortgage broker in Western Australia, the most awarded broker I know, Sam Carrello. How you going, mate?
Very, very good, mate. Thank you for that nice introduction.
Hey, you had a couple of weeks off on holiday. You're back at it, and something that is probably one of the proudest moments in my career at Strategic is that you've also decided to join the team here at Strategic Mortgages. Thanks for coming on, and it's interesting to have one of our own now after all these years on the podcast.
Thanks, mate. Yeah, obviously opportunity popped up, so yeah, really happy to be here, and thanks to you on the team for making not only myself but Rasheen's come across with me too, which can't go amiss. So she's come on board with us as well. So yeah, looking forward to getting into it, and essentially same service proposition from our end, just a change in the logo. But yeah, excited for what the future holds.
As I said, really proud to have you on board, and for one of very, very few plugs we've ever had on this podcast, as I always would have anyway, whether you were here or not at Strategic. To everyone out there, if you are looking for a mortgage, this man is the best in the business. So get on board, have a look at strategicmortgagesperth.com.au. Let's get to the episode. We're talking about mortgages, finance, and I guess the lay of the land at the moment. It's been a while since we've done a mortgage update in terms of rates. Let's go through it one by one if we can, mate, and just get that out of the way before talking a bit more strategy and future.
The rates have been pretty steady last few months. Obviously, there hasn't been an increase on the cash rate with the RBA. We've seen a little bit of movement in terms of the variable rates. What we're seeing there is if the banks are trying to open the door for business, they may offer an extra discount to try and get clients in. At the same time, if they've got enough in the pipe for a little while, those discounts reduce. So essentially how they work is the banks typically will have a standard variable rate, which may be, say, 8.5%. And then based on your position or your scenario, they'll give you a discount off that rate. So hypothetically, say the standard rate's 8.5 at the moment, say a Bank West on the books is offering 6.34, so you get a discount off that. At the same time, Bankwest are open for business, so we've actually got access to rates that are cheaper, and we're sort of seeing 619s, maybe even a little bit cheaper.
So that's through a broker, right? So you're actually having to go and ask the question, a pricing tool, a broker would call it, online, to have a human at Bankwest have a look at the profile of that client and provide a discretionary discount over and above the rate that you would see on the website.
Correct, yeah, 100%. And all the banks do this, so obviously they're targeting ideally that 20% deposit. Some banks will even offer a little bit more off if you have a 30% deposit. Also loan size factors in, so obviously sub 500 will get potentially a different rate compared to, say, if you're borrowing $1 million.
It is an interesting dynamic at the moment, isn't it? Because as you said, rates haven't moved for a long time. So the cost of business for these banks materially isn't moving right now, but we are seeing rates continue to change. The jostling for position at number 1, 2, 3 between the banks for who's got the cheapest rate right now, whether it's in owner-occupied, principal, owner-occupied, investor, P&I, interest only. We'll talk about who's winning that race right now, but it is interesting to note how commercial that market is, right? How banks one week will be at 6.4 and the next week will be at 6.2 and will jump back the week after, simply based on the profile of client they're looking for and how much business has gone through the door last week.
Especially some of these big banks, their big base in terms of their net interest margin and what they need to make on the deal does affect it as well, what they're buying their wholesale funds at. But it does change quite regularly, although you might not see it in terms of a headline rate. By jostling that discount, it does give them the ability to open the door or close it. At the same time, by changing the discount, it doesn't get a news headline because you're not increasing the rate, you're reducing the discount. So by doing that, it doesn't get them a bad news story, which typically, once the RBA say they were to put rates up, whoever moves first usually get
smashed
hammered.
On radio, right?
Yeah, hammered in the media. So say it's Commonwealth who move first, they're the devil. So by playing around with the discount, it just gives them a different lever to pull, which probably is a little bit more under the table. I will also touch on, if you went back 12 months, there was a big war in terms of refinances with cashbacks and things like that.
Are we doing that still?
There's literally one or two lenders out there that are still doing it. Pretty much everyone, and Commonwealth was the first to do it, or the first to pull it and said, we're not offering cashbacks for refinances. There were other lenders like Macquarie who just stuck out of it. They said, you know what, we know what we're offering. We're consistent. We're good. We're offering a good rate. and they continue to do that, we're not going to get involved. But the cashbacks have disappeared, which...
Is that a good thing?
I think it is. When you're enticing, say, someone with $5,000 to move, doesn't necessarily mean it's in their best interest. And what you find is some clients were jumping around to 3 or 4 banks, and then at the end of it, they're moving for the cash, but they don't take into account costs, they don't take into account structure, they don't take into account time. So I think removing the cashback refinance rebates was a really good thing. And the other bit there, which I've been pretty happy with, is that the banks have almost reinvested that to be able to offer sharper rates to their existing clients. So
it does seem that existing clients, by virtue of the way that it's so competitive for new clients, seem to get shafted. If I haven't asked the question, just like with an insurance policy, I seem to have an interest rate that's actually not as good as someone who's just jumping through the door. And you've got to ask, what's that all about? I've been a client for 10 years. Why am I getting 6.6 when someone's advertising 6.3? And then I go and ask the question, and you won't give me 6.3.
100%. And what we're seeing is the retention teams at the banks, say the new to bank rate is a 619, for example. CBA are pretty good at this. You might get a 632 or a 629 to stay with them. And when you factor in that 0.1% on, say, a $500,000 loan, it's $42 a month in interest. So it's not worth clients to switch, because to switch banks, now the refinance rebates are gone, you're not getting $2,000.
Might cost you $1,000.
Well, it does. Your mortgages are $210 a piece. You got 2 of those. Discharge fees typically $350, and then you've got your new annual fee into the new bank. So yeah, you're looking at north of $1,000.
So they're smart about it. They're like, what's the amount we need to give you just to keep you, rather than to actually keep you in par with new to bank?
Correct.
That's pretty poor.
Yeah. So typically what we're seeing is that lenders will price 0.1 to 0.2 above potentially new to bank, which it's better than probably what the client was paying. It's not new to bank, but it's not worth that change. The hassle of changing bank accounts, setting everything up again, and then you're not actually going to be in front for a good 12 months typically.
Yeah. Let's go to those rates. Let's start with an owner-occupier and principal and interest. What's the top couple of rates we're seeing right now?
Yeah, so on a variable, looking around that 614% with, fully functional offset, 100%. Got ING, Macquarie, Bank West are doing a little bit of that, Westpac. So there's a few banks in there, St. George, who are...
So it's a lot of banks right now pegging against each other, just over 6%.
Yeah. So typically what we find is we can usually price most lenders against each other, and they all sit probably between 0.05 and 0.1 difference. So you can usually get a pretty competitive rate, and at that level it doesn't make a huge difference. And as we always say, the key is, well, first and foremost, where are you going to get approved? There's no point going for that best rate if they're going to decline you. So we're seeing the banks being competitive in terms of the variable space. On a fixed rate, we aren't seeing a lot of clients take up a fixed rate loan. Macquarie really sharpened this space, and across the 1 to 5 years, I think they're leading the way pretty much the whole way for 589 or 599 for a 1 to 5 year fix.
It doesn't feel like a rate that would be a smart rate to lock in if price was my number one focus.
Correct. That's Macquarie at the front. You essentially... Westpac as a comparable, they're sitting to mid-sixes. So why would you fix in for mid-sixes when your variable rate's cheaper? And the longer-term forecast is that rates will hopefully come down next year.
Yeah, you don't want to be that schmuck where everyone else is finally at variable rates of 5.2 in a year's time, let's just say, and you're still at 5.89 for the next 4 years. That would hurt.
And the other thing there with the fixed rates, which I think we've touched on before, is a lot of fixed rates won't offer an offset account, and they do limit how much you can repay, whether that's 5 or 10,000 over and above. So with the fixed rates, just a warning, when fixed rates were 2%, you couldn't go wrong.
Thanks for coming.
Yeah, but I think we're seeing the last of those disappear now in terms of the clients that were on them, and you're sort of looking north of 6.
Okay, let's flick over to investors, and let's start with principal and interest there as well. What's happening in the variable space?
Variable space starting at 632, 634 for 70% land, 80% land, you're looking in the 640s. Typically, owner-occ P&I to investment P&I, you're typically 0.3 higher.
That's a lower spread than it used to be 4 or 5 years ago. It feels like they're penalising the investor a little less than they used to.
Well, I think the regulations changed. So before, prior, they didn't have more than 30, I think it was 30% of your book investor interest only. They got released probably a year and a half, 2 years ago.
Okay, so really it's just allowing them to be a bit more competitive in that space rather than having to pull back and offer less good rates.
Correct. I mean, ultimately it's the same money, right? If you borrow it for
It is.
investor or owner-occ, it's the same funds. The difference is obviously the bank's compliance and regulations, making sure that they only lend a certain amount of investor out.
What about for interest only? It's not something that we saw a lot of over the last few years, but I think you're starting to see, especially with rates the way they are right now, investors fleeing back to the interest only space just for cash flow.
Interest only rates, again, you're typically looking 0.2 above those investor P&I. As a variable, I think best in market is 654 investor interest only for a 20% deposit, over $500,000 in lending. Typically, the majors will sit around that 664 to 669. Again, you're probably about 0.5% higher than you are on an owner-occ P&I, and probably another 0.2 above the investor P&I.
For me, as a variable rate, it is something I would think that people would start to consider now. It's not so much of a penalty as it used to be an investor interest-only client as it was a few years ago. And if cash flow is starting to become an issue for you as an investor, given interest rates, or maybe you've bought a property recently and rents aren't 100% covering your cash flow, it's an option. It's something that you can consider. Let's look forward for a second. It's very risky to do that, but we've had a bit of information come through from the RBA over the last couple of weeks. You got a lot of economists who think the cash rate should have increased by now, and just as many who think it should have dropped by now, actually. And what we're finding is that the bonds market is essentially now pricing in a drop by the end of the year, despite the fact the governor of the RBA, Michelle Bullock, has said it ain't happening. It's a very strange situation right now of will she, won't she, what's going with the market, not to mention just where is the market going globally. You start to see Bank of England, the ECB and the Fed all starting to move into a drop phase when it comes to cash rates. It doesn't take that long before we start following usually. And data in the inflation and wage growth and unemployment space is starting to move that way. What are most of your clients saying about their concerns? Are they worried it's going up? Are they asking that question every week?
Yeah, I think most conversations revolve around when are they going to start coming down. I think for that to happen, just some data from the RBA, they want to see wage growth decrease and unemployment increase. So there has been a fair bit of spend from the government in terms of wage increases to certain areas like aged care and childcare, as well as obviously pretty big infrastructure spend. So this has, according to the RBA, kept inflation a little bit higher than what they want to see. So they're saying that they do want to see that unemployment rate probably get 4.5% and then wage growth kick back to about 3.5% before they'll look to start moving the interest rate. Depending on which bank economists you follow, there is a couple that were saying they do expect an increase. Most of the majors are forecasting a decrease to start next year, hopefully at the February meeting, as the RBA are now meeting only 8 times a year rather than 11. But a lot of the economists are saying that February they expect a rate decrease, but who knows, mate? It's pretty hard to pick at the moment.
Isn't it an interesting paradigm that in order for many Australians' cost of living to drop with interest rates dropping, we need to see lower wage growth and less people employed? It just seems like a double-edged sword for punters, doesn't it?
For the battling Aussie, and we're having calls and a lot of people have used up those savings. I think on the ground, the everyday Aussie is feeling it. Mortgage repayments have gone up almost double.
Especially people who have been buying recently, right? They're paying big numbers.
Correct, yeah. Some of the contracts we're seeing come across, you and Lockie touch on it, but if you bought 2 years ago, some of the growth in these suburbs is wild. We're seeing some properties purchased a couple of years ago for 600, now going for 9s, really big growth. But
we'll think about the mortgage on that, right?
And that's the thing. So we are seeing clients, especially if there's been a change in situation, drop to one wage, have had a child, example, that are burning through their savings and, they're not going on that holiday. They're probably not eating out. And I think the retail and hospitality sector is hurting a little bit based on that.
Well, let's talk about people's plans. I'm sure you get a lot of calls from people who have recognised that their equity has increased. Finally, in Western Australia, we're not talking about negative equity. We're talking about what do I do with this equity? It's a nice place to be in compared to, let's say, 5-6 years ago, where a lot of people were scratching around for something to do with the value of their property. Now it feels like a lot of our friends and clients bought at $550 with a mortgage of $440 and it's now worth $700 and something. What do I do with the extra couple $100,000, Trent? Should I buy an investment property? Should I upgrade? Can I refinance? Can I keep the house and buy another one? All these questions start to come up, which is good. It's good to have options finally in Western Australia. But I guess the reality comes down to, most importantly, given interest rates in the last 3 or 4 years have tripled, essentially. Yep. Could you actually afford the loan you got 3 or 4 years ago if you were to buy it again in the first place, let alone an investment property? Are you seeing a bit of that risk?
Yeah, definitely. I think 3 or 4 years ago, I'd say 2022, 2021, the banks were actually capping people's debt to income to 9 times. So we had clients who could service more than 9 times their income, but the bank would cap it at some at 8 times, some at 9 times. Now that same client, if you're getting 5 times, you're doing pretty good. So 5 times your income as your borrowing capacity.
So think just that limitation straight away, right?
Correct. So people can't borrow as much as they did. So it's great everyone having equity, but the affordability piece is what's hurting people at the moment.
That's the limiter.
Correct, yeah. So there's always 2 parts to it. So it's deposit or equity, and then it's the serviceability. So deposit and equity, a lot of people who are coming through we're seeing have plenty of equity, which is tick 1. But tick 2 is, can we actually service the debt? And it's not as simple as, oh, well, the rental I'll get on that's, $600-700 a week. Oh, the mortgage repayment's $3,000, so it looks after itself. It's not like that. The banks obviously apply these buffers and assessment rates, which carve it away quite drastically.
Well, let's use it as an example. If it's going to be $3,000 as your hard interest payment that month, they're looking for you to, pay it off at some point too. Let's say you have interest only for 5 years. Well, they want to see that you can pay the principal in 25 years after that with the income you have today. And also they'll add a buffer rate that adds 3%, which would be 50% to your interest payment, right? So now that $3,000, they're looking at it as more like $4,500. They want to see, can you pay off $4,500? And well, yeah, you're going to have a rent of $600 a week, but actually we're going to shade that back by 20%. So now we're at $480. So you're going to get $480 a week in rent. Can you pay off $4,500 a month? There you start to see a bit of a gap. It's not a real gap, but that's how they keep you and them protected from mortgage stress.
Correct. Obviously, GFC in the US, it wasn't like that. We're pretty stringent in Australia, and that's why we've got a strong mortgage market. And I think defaults are less than 1%.
But that's what's getting in the way of people's aspirations right now. It's probably not their equity. If there is a problem, it's probably their ability to not only be able to refinance their current property, but to be able to extend even with rental income coming in as well.
Yeah, like most clients are getting assessed at 9.5% interest rates, which are pretty big,
Let's explore things for those people where that isn't the problem. They've got the equity, they've got $300,000-400,000 they've made in the last 5 years. Thanks for coming. And they've also increased their wages, they've got plenty of serviceability, and they want to do something with that equity. They go, Sam, I've got this money now. I feel like I should be doing something with it. I don't want to just pay my mortgage off. I would like to increase my exposure to the property market, and I want to keep my family home. So that investment property would be great. How do I set that up?
What we typically recommend, so the bank will lend to 80% on your owner-occupier. So let's just do round numbers for me to make it easy. So say the owner-occ's worth $1 million, we can lend up to $800,000 on that. Say the current mortgage on that, say $500,000. What that means is you've got $300,000 in equity that you can potentially draw out. Say you're buying an investment property for $750,000. How we would look to structure it is we would look to lend typically 80% against that investment property, which is $600,000. And then for the other $150,000 plus your fees, we would give you a separate loan secured by the owner-occupied home. So what we do is on the investment property, that would be investment loan 1, secured solely by that property.
At 80%?
At 80%. And then investment loan 2 would be secured by the owner-occupier, and we would give them 150 plus, say, 35 for costs, so 185,000, and that would be noted as investment loan 2.
But that's what helps to keep these properties separate. If you ever wanted to sell one, revalue one, those sort of things, they're not cross-securitized.
Correct. It just keeps the control in your hand rather than the bank. If you cross them and then you want to sell one of them and there's been a market downturn, for example, the banks actually control the release of those funds. So they might say, well, if we've crossed them, we want to revalue both properties. Say the market's gone back 10%, which we're not expecting anytime soon, but say it did. That means they could control the release of the funds and get you to pay down other debt, which you may or may not want to do.
I think this is something that's going to be really relevant to a lot of people right now. If you haven't already gone into this space, or, for example, if you have gone and purchased an investment property and you haven't done it this way, it would make sense to have a chat to a broker about refinancing in this structure, just so that you can have that control back if things do start to go south in the future that Sam was talking about. It really is quite an important risk mitigation strategy that brokers can offer their clients.
It's no real extra work to do it, but it's just that extra layer of protection for you.
So let's say we're in that position where we've got equity, We've still got the servicing to increase our loan a bit more, but we actually don't want to buy another investment property or investment property at all. We just want to renovate the house we live in. Maybe throw a second story on, do some cosmetic renovations, add a big shed at the back, who knows? But we want to access that extra cash. How would we do that?
Yeah, we're actually seeing quite a few clients inquire about this. I think obviously the market here in Perth's very, very tight and the costs are increasing. And when you look at, obviously your stamp duty and your selling cost, for clients to actually upgrade to that next level, right now they're potentially not seeing value. So what they're doing is they're saying, well, we actually really like where we live.
Yeah.
We just need an extra room. So let's do an extension or a renovation on it or update the kitchen. So if you're in a position where you've got that equity, depending on the type of renovation you're looking to do or extension and how much you're looking to take out, there's ways we can structure it. A lot of banks, cash out policies up to 100,000 are pretty good.
With minimal questions asked, really?
Yeah, you just need stated purpose.
Yep.
So just let them know what you're looking to do. Typically, if you are looking to do a structural renovation, the banks do typically want a control release of those funds. That's where you get a standard construction loan.
Yeah, like a build contract, really. That's what they're going to want to see.
Correct. And that's just to mitigate the risk of giving you $250,000, $300,000 and then the builder going under halfway, or which is a big thing.
It's probably in your interest as a client. You don't want to be handing that money straight over to a builder if they're not going to get it done.
Correct. And you don't want to hand it to them straight away. So they'll do those progress draws at each stage. They will obviously request the invoice from the builder and then they'll release that money directly to the builder.
Yeah.
There has been a few building companies go under, so it's important when you are looking at doing a renovation or a build or an extension, you do go with a reputable one, just based purely on that. And, if someone said, I want the money up front, I'd definitely be asking questions.
That's right. Now let's go to the final stage here. We're looking to upsize. Again, we've got some equity in our property now. If we were to sell tomorrow, we've got the cash to have a nice big deposit for a $1.5 million house that maybe we never thought we could afford. We've gone to see Sam. Sam said, yep, we've got the serviceability. We can do this. We can get a loan for 1.2 mil, for example, and the rest we can throw down $300,000 as our deposit plus our stamp duty. We're all good to go. But the problem is right now for a lot of people, where do we go in the meantime? We can't really sell the house right now. We've just found the house we'd like to buy and we have to put an offer down tomorrow. What strategies have we got there in terms of bridging loans and all that? And how does that work?
Yeah, so bridging loan, again, has become very popular just because people in that position, they know they're going to sell theirs quickly. They don't necessarily want to put theirs on the market and accept an offer before they don't want to be homeless. Yeah, before they got somewhere to go. So I think Lockie's maybe touched on a few options here in terms of rent back and things like that. But a bridging loan is definitely an option. So essentially, there's lenders out there who will look to lend 100% of your new purchase plus your fees if need be, for up to 6 months typically. And then when you sell your property, the funds come in and clear that bridging loan. So it's like a short-term loan. The rates are typically high, at the moment close to 10% for that 6-month period, or for however long you keep it. Say you only need a 2-week switchover, you pay that higher rate for 2 weeks, and then once the funds come in from the sale of your property,
they just drop it down to 6 point something.
Yeah, you'd be low sixes.
That gives you quite a bit of confidence, I think, to be able to make that change overnight. I think that's what's holding a lot of people back right now from putting their property on the market. They'd like to upsize. They haven't found a property yet. Even when they do, they're not sure about the strategy, the offers they're going to put down, just like we spoke about previously with Lachlan about those buying strategies too. And then it's the final piece about, look, what do I do with my finance? How do I make sure I'm not homeless, even if it's for 2 days? So I think tying those strategies together from a buying side, a selling side, and a finance side, if we can listen to these episodes together, people, you've got that solution there if you are looking to make that upsize or right size or even a downsize. It might be into a property that's cheaper than the one you have now. You just don't have the cash for the deposit.
Yeah, typically we find the bridge does work good for the downsize better than the upsize unless you've got the equity. Like I said, there's lenders out there who will assess your serviceability on your end debt, so your end position. So once it's all said and done, which is fantastic because, yeah, if you're going from a 1 mil property to a 1.5 and you're carrying $2 million worth of debt,
yeah,
that
won't work.
Correct. It's a lot different to assessing someone carrying $1 million.
Yeah.
So you go, well, all right, the bridge rate is higher, but it's a solution to get you into the property for a short period of time. You've got up to 6 months to sell, and typically people line up settlements within 2 to 4 weeks.
You think you'd be right in this market, wouldn't you?
Definitely. And the other key thing there is when you put in an offer and you're not doing subject to sale, you're doing subject to finance.
Yeah, which is a lot easier to consume as a seller right now.
A lot of properties have 5 to 10 buyers on them, right?
Yeah.
Why would I take an offer with someone who needs to sell their place and my finance or me doing what I want to do is based on them getting a price for theirs? I don't know if they're realistic or not. It's much better subject to finance. Cool. Yeah, you got your pre-approval, which we're seeing is definitely needed in this market. If you're going out there and you don't have a pre-approval, there's some agents that just won't even entertain the offer.
Yeah. Sam, we've had a great chat today. Love having you on board. Love the update to the rates. Love the strategies moving forward for our listeners in terms of buying, upsizing, investing, renovating. Everyone is doing something right now and they all need a broker. So thanks for outlining all those strategies, mate. We'll speak to you again.
Yep. All right. Thanks for having me. Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!